We're talking gold forecast today with Ross Strachan. He covers precious metals demand for Thomson Reuters GFMS, and they launched their gold survey today, so we're going to get his input now. Ross, thanks so much for joining us.
You're very welcome. It's a pleasure.
So, Ross, let's talk about your gold forecast. You're expecting gold to fall below $1,200 an ounce this year. Let's talk about how you see the metal performing.
Yes, Daniela, that's absolutely right. We do see the price dropping back below 1,200. We had been expecting a rally after the US announced their change in interest rates back in December, and we've seen that, and that's been even stronger than we anticipated back then. But what we're seeing now is really that many people have factored in far too high a chance for there being a recession in the US, which we do not think is likely. And as that risk aversion pulls away, we think gold will be drawn back down in price, not least as the major physical markets in China and India are both suffering from weak demand at present.
So when you say gold is heading back down below 1,200, which price range are you seeing it trading within, and in which time frame?
Well, I think crucially there, we believe that the lows of this price cycle have already been seen of 1050. We do not expect the price to go anywhere close to that. In fact, our low for this year is expected to be around $1,150 an ounce. And we would expect that probably to occur sometime around the third quarter of this year before we start to see a further rebound and recovery of what we see as a long-term cyclical uptrend.
So would you say that's a bearish forecast? How do you label that, Ross?
I would label that actually as overall a bullish forecast, but obviously in the short term, from a short term and particularly for technical traders, that is naturally bearish in over the next few months.
So, Ross, a common denominator seems to be, with your survey and other surveys I've seen put out this week, is that there's a consensus that the U.S. economy will recover. So how much will that weigh on the price of the metal?
I am bullish, in fact. I think there's very much been far too much hesitancy in the market about the state of the U.S. economy. Clearly, there are concerns about the effect of global growth and how weak that is across many emerging markets, and therefore the knock-on impact for exports, particularly given the situation with the much stronger dollar. However, the US Federal Reserve is very aware of this, and I think you've seen the movements even in recent days from Janet Yellen, shows that they're going to be looking at the whole picture when they move ahead. As such, any rate rises will be very protracted and very slow, and remaining very accommodative to reasonable US growth. Nothing stellar, but still reasonable US growth in the order of 2 to 2.5%. as the U.S. economy gradually gets back on track.
Let's talk about central bank buying now. What are you seeing on that front? Do you think China will be more active and more regular buyers here? And how is that being priced into your forecast?
That's a very interesting point. I mean, the central banks as a whole have the second highest level since the end of the gold standard in net purchasing in 2015. As we said in the report launched today. And what you will continue to see supporting that is China and Russia continuing to make very, very regular purchases. In the case of China, whereas in the past they only announced their updates to the IMF on a roughly once every 6-year basis, they have now started to report every month regular purchases in the region of sort of 15 to 20 tons a month. And we would very much expect that sort of broad trend to continue. In the case of Russia, we think that their pace of buying may well actually drop back as time goes on due to the economic woes and the fact that they already have a much higher level of gold as part of their foreign exchange reserves.
Thanks for joining us, Ross.
You're very welcome.
And thanks for watching this edition of Kitco News. We'll see you tomorrow.